If you own a rental property in Denver right now, you've likely seen some scary headlines. Rents dropping, vacancies at a 16-year high, concessions through the roof, the list goes on. Today, I'm going to show you what the data actually says and what it means for your property, because there's a big difference between the story the news is telling and the story your particular property might be living. I'm Ben Burnett with Grace Property Management, and this is your April 2026 Denver rental market update. What actually happened to the Denver rental market? One word, supply. In 2024, Denver delivered roughly 19,000 new apartment units, the peak. For 2026, CoStar projects just under 5,000 completions, down 74% from that peak against 6,000 units being absorbed. This means demand could outpace supply for the first time in years if projections hold. Here's what that looks like. 2022, 2023, building steadily. 2024, likely the peak, roughly 19,000 units. Those buildings were permitted back in 2021 and 2022 when rents were surging and interest rates were near zero. By the time they opened, the market had completely changed. 2026, less than half of the 10-year average is expected. And here's the key chart. Demand on one line and supply on the other. For the first time in years, demand is projected to cross above supply in 2026. If the forecast holds, the wave is cresting and it recedes from here. This is the most important slide in the video. The market remains segmented. The scary headlines, they're almost entirely about large apartment complexes, the 200, 300 unit buildings. In this left column, that shows 7.6% vacancy, a 16-year high, negative almost 5% rent growth, and concessions at a 21-year record near 10%. On the right column, we have single families, duplexes, and even some small multifamily will make this category. Vacancy around 4%, almost half of the apartment rate, plus 2 to 3% rent growth forecast with minimal concessions. If you own a house or a small building in a quality Denver neighborhood, you're not in the same market the news is reporting on. Here it is visually on vacancy. Single family around 4%, and Denver apartments near 8%. Different markets. And the rent data tells the same story. Single family and small multifamily trending up, plus 2 to 3% year over year, while apartments are trending down, negative almost 5% to about $1,750 a month. Two completely different markets. Some real numbers. Average apartment rent today, according to Rent Cafe, is $1,885. Median across all property types is near $1,900, according to Zumper. Apartment vacancy, as mentioned, is 7.6%, a 16-year high, and single family is around 4%. Single family rent growth is still forecasted for a 2 to 3% increase this year. That's not a crisis, that is a normal market. And the one I want you to really hear, per CBRE, it costs around $2,000 more per month to own a home in Denver than to rent one if they were to purchase that home today. That gap grew almost 7% last year. That's your renter pool, huge, motivated, and likely not going anywhere anytime soon. Let's zoom out. Denver isn't alone. Nationally, a 7.3% vacancy rate with median rent around $1,350. Time on market continues to tick up, averaging around 38 days, according to Apartment List last month. This isn't a Denver problem, it's a national construction cycle. Denver is grouped with the Austin, Phoenix, and Tampas of our country, the cities that built aggressively from 2022 to 2024 and could have overdone the Class A apartments a bit. Here's the critical part. The pipeline is drying up. About 20,000 permitted units can't break ground. The under construction pipeline is more than 40% below the 10-year average. The city just proposed a 3-year deadline extension to keep projects alive. As Mark Williams at AAMD put it, the overwhelming and complex regulations are chasing investment away from Colorado. The supply that caused the problem, it's not coming back anytime soon, according to these numbers. Look at the trajectory. 2024 peak, dropping hard through 2025 and 2026, and by 2027, CBRE points to an undersupply, and that's when the pricing power will return if these projections hold. Despite the headwinds, 4 forces support Denver's rental demand. One is the $2,000 a month gap between renting and owning. 2 is the renter costs are up nearly 30% since 2019. That tends to keep residents from moving too often. Three, 58% of Denver renters surged with low urgency in December, the second highest in the nation. And lastly, Denver's employment base remains strong, we have good industry, and the fundamentals remain intact. Here's that rent gap visually. Steady growth since 2022, and $2,000 a month is what it was at last month according to CBRE, your structural tailwind. So what do you actually do? Three moves. One, retain your tenants. A quality tenant beats a theoretical higher rent after 30 to 60 days of vacancy and turnover every day of the week. Reach out early and get those renewals in place. Price for today's market, check Zillow, Rent Cafe, and Zumper monthly. For single families, hold flat or modest increases, and for apartments, you may need to even consider staying flat or going down. And lastly, maintain your properties. In a market with renters have a 16 years worth of supply choices, condition is your edge. End of story. Here's the outlook, and this is a forecast, not a guarantee. Q1, Q2, soft market continues, apartments are competing hard, single families are still stable, and if you have a vacancy, you should fill it rather than trying to maximize rent. Over the last part of the year, Q3, Q4, analysts expect this tipping point, supply to taper, absorption to rise, and single family growth to start showing up further. In 2027 beyond, a pipeline at a decade low, pricing power should return. Landlords who hold, maintain well, and retain tenants now are the ones who will capture the gains ahead. If you're already a client, we're tracking these changes and adjusting every single day. And if you're not a client of ours, please do consider us a resource. We'd love to help out and answer any questions you may have. Thanks for watching, and I'll see you in the next video.